Well, good afternoon. Happy Friday, August 28th. Mark Milam here. So finishing out the week, kind of where we started it in terms of overall interest rates, but it's been an interesting journey to get here. We saw some improvement earlier in the week, have given some of that back. Eventful day today, even Friday here, as we've had the Jackson Hole Symposium, the Fed Chairman Kevin Warsh speaking from that symposium. We get the University of Michigan Consumer Sentiment Index came in this morning as well. Lots to get to. Let's take a quick look at it here. When you look at mortgage-backed securities, finishing out the week roughly the same as where we started it. No huge moves. We had a nice pickup earlier in the week. We've given some of those gains back. So effectively, no significant changes to rate, but that doesn't mean nothing significant to pay attention to. Here came personal consumption expenditures. This is the core figure, came in at 3.3% year over year. This strips out food and energy, so no blaming the price of oil for 3.3% being well above the Fed's target rate of 2%. The overall number, including food and energy, was at 3.7%. So inflation persisting above trend now for the 65th consecutive month. That's an awful long time to miss on your mandate for price stability. And I think it also led to the Fed's comments today about a little more hawkish views on inflation. We come down here, it doesn't show on this table the University of Michigan Final Consumer Sentiment Index, but it came in at 51.7. Really anything below roughly about 100 is considered to be a pessimistic reading on the economy. So this is certainly that. And if you go back and look at new home sales reported on Tuesday, came in at an annualized rate of 607,000. That was significantly lower than anticipated reading for new home sales. So higher interest rates, higher inflation taking its toll on the housing market. Here's the Consumer Sentiment Index, and this is the most recent reading right here in August at 51.7. Again, 100 is the baseline for the index. We've spent a lot of time below 100 since the end of the pandemic. And if you sort of compare this Consumer Sentiment Index up here at the top to the levels of deficit, the annual levels of deficit for the federal budget, you can see a bit of a correlation here. If you go back here and look at high consumer sentiment in the late 1990s, you can see what was happening with the budget surplus. This is the last time we actually ran a budget surplus, and you can see how consumer sentiment was affected there. Here are futures traders talking about the next Fed meeting in September the 16th, and you can see as of yesterday, we were anticipating about a 35% chance that the Fed might hike. And then as of today, now up to 60% on the chance that the Fed might hike. This is reflective of Fed Chairman Kevin Warsh's comments out of the Jackson Hole Symposium. And candidly, we actually think it would be relatively good for the long end of the yield curve and relatively good for mortgage rates for the Fed to take short-term rates up a little bit. We think there might be a little bit of balancing out on the long end of the yield curve. Only time will tell, and we'll certainly wait for mid-September to see if that bears out. In the meantime, if I can be of any service to you over the weekend, don't hesitate to reach out. Mark.Milam at HighlandMTG.com. Have a good weekend.